Javier says, how would you suggest I manage this scenario? I purchased NVIDIA at 141.57 3 days ago, NVDA, all right? Sold a deep in the money covered call 120 strike, February 21st expiration. Excellent. So we're looking at some good downside protection. We're looking at some good premium. You collected 24.14. Okay. Down very little overall, but what are my options if the price continues to drop? So let me write that down. Feb 21, sir. All right, Javier, let's take a look. And to take a look, we're going to walk through the process of setting up a portfolio, entering your position, and then looking at the position analysis and the rollout opportunities, as well as we're going to consider some other concepts as well. So again, I'm going to go to my portfolio, just the main tab, and we're going to click setup. Now, here's a bunch of ones we've done from the different webinars. Here's the one we did from the webinar from last week, comparing married puts to leap spreads, simulated CDs, the deep in the money covered calls, far out in times, and collar positions as well. An old one playing the rate hike back from 2000. So I got to clean these up. We're in a new year, but hey, we'll do that later. First things first, we'll call this January 10th, 2025. Javier has, we're just going to say 100 shares in NVIDIA, so we need at least $14,000, but we're going to put this at a $30,000 account. So I'm going to start a portfolio with $30,000, and we're going to copy that over. And we're going to say we created this back on January 2nd. All right, let's save all changes. Now I've created a portfolio. I've got all my existing portfolios. We've got our new one in there as well for January 10th, 2025. Whenever I start a new portfolio, I make sure that the starting basis is equal to the cash on hand. So now that when I start adding the positions that are in my trading account, it starts taking off the cash on hand, and I have pretty much close to the exact record that I should have in my portfolio. Now, to track our open positions, to enter new positions, we click on the sub-tab for portfolios. And it took us to the new one we created with no available positions. And so now what we want to do, we have a covered call, an in-the-money covered call for Javier. So we're going to enter a new position. We're going to select our strategy. We're going to go to covered call / buy right. And it just prompts us to enter it as you would if you were entering a position in your portfolio. We have NVIDIA. We're just going to do 100 shares. We're going to say we opened this 3 days ago. So on the 7th, why not? And our price per share, 141.57. At the same time, we're going to sell one, February 21, in the money, 120 strike call. And we sold this position at 24.14. We're not going to include commission fees, but naturally you could put those in as well. We're going to keep the date the same just for simplicity. Now, you don't have to worry about a position name. You could put that in and say, hey, this is my NVIDIA covered call. Why would that be important? Well, if I'm tracking positions in the portfolio, I may have a NVIDIA covered call. I may have a bull put spread on NVIDIA. I may have a long call on NVIDIA, and I want to kind of keep them separate. I want to keep the position and the description separate. So when I look at analysis, I can break down, hey, this was my covered call on NVIDIA. These are my other subtle options trades. But in general, if I just have a portfolio of 8 or 9 covered calls, a few bull put spreads, they're all on different stocks, don't need to worry about the name or the description, but it's there if you want to use that, Javier, for different tracking. Where are we right now? Oh, no. Let me reload the page and yell at the programmers later, because it looks like, again, we have this little hang here. That's the problem when you implement a new thing. That's what I mentioned earlier, that this is out here. I think it's still going to work okay, but we're going to take a look at it. Ignore that. NVIDIA. We have got the stock 141.57. It's down to 135.49. Javier is down 566 on the stock, or 4%. Now, this call option is still roughly 42 days out in time. We're going to see a relatively slow time decay at first, even though the stock has dropped. So it has gained 534, in Javier's favor, but we're losing 566, of course, on the stock. So we're about at a balance. As Javier mentioned, he's like, I'm not down that much. Yeah, you're only down 0.3%. Sidebar real quick. There are various views in the portfolio. The standard view just gives you a breakdown of the stock and the option. You don't see those initial 6 columns that you saw when I had it selected stock analysis. Why is it important to have those? When I'm tracking my spread positions, covered calls even, calendar spreads, bull put credit spreads, this stock analysis view gives me those extra 6 columns. I can see the total position cost, the original expected gain of the combined legs together, the current liquidation value, we're in a good spot, Javier, no problem, and the potential return if assigned, in Javier's case, if NVIDIA stays above 120 in the next 42 days. Or maybe it goes back up. We get some good news next week with the inflation values and what the Fed is thinking. This pops back up towards the 140, 150 area, maybe a little bit more, Javier, and you get closer to intrinsic value. All right. So again, I apologize for that. Little differences there that you see. Normally you don't see that, but that's just coming up because the programmers are working on changes, which they tend to do when I'm on a webinar, and I don't want them to do. Now, general concepts of rolling an adjusted position. Let's go ahead and go to the position analysis view, the PPA. We're going to use that quick link. You bought the stock at 140, 157. You sold an in-the-money 120 call. We've got a fair amount of downside protection. Your break even is down to 117.43. All right, so it's about $24 from your initial purchase price. Okay, the premium that we collected, naturally, that $24.14. And so what that gives us, of course, we've got about a 6% downside protection, 5 or 6% downside protection, around 6% downside protection. The stock has only dropped roughly about $6, so that $5.63 we saw. So we're down probably, about 3%. What was it, 2.5%, 3%? The stock is at 4%. My apologies, Javier, 4%. Now, the reason why I mention that is with these deep in the money covered calls, as a general rule, and it's even discussed in the monthly covered call picks of the day, Ernie's preferred criteria that he developed and researched over time in different market conditions for finding covered calls that perform the best using monthly and weekly. That's the weekly and monthly picks of the day. But as a guideline, we still follow the general concept, of course, that, I'd say Bill O'Neill does from Investors Business Daily, that if the stock falls 7% from our initial entry price, or in this case, about $10 from your 140, 157 strike price, so down to 131, we might consider making an adjustment on the position because the stock's not going in the direction that we wanted to. We're not there yet. We're 135.91. On the same side, you collected 24.41, I think it was 14. My apologies, getting the numbers backwards. 24.14 on a cost basis of 141.57. So you've got a 17% downside protection. I might be willing to allow this to go down 10 or 12% before I start considering adjustments, Javier, that I might make on the position. Now, first, what is my step I'm going to do in my PowerOptions portfolio? I've got a 17.1% downside protection. Simply the option premium of 24.14 divided by the stock price. How far can the stock drop before I'm technically losing money on the position? I might not let it go to 15, but maybe 10 or 12% instead of the 7% default I mentioned. Or if the stock even drops below our 120 strike price, which would be beyond, of course, that 10 or 12%. So what I'm going to do is go ahead and click on View in the Alerts column. This is going to take me to Alerts and PowerOptions. Now I can do it by a stock percent change. I want to be notified if the stock drops. We'll keep it at 10%. I'm going to mark that as red. That's a warning. I could also use the lower limit I mentioned, or I could put it on the option itself. If the option delta reaches a certain range, if the option goes in the money by at least 0%, I want to be notified. So it's just below my strike price that we sold, the 120 strike that you sold, Javier. I'd like to be notified. And of course, if I want to be notified of days remaining to expiration, option percentage change, if I've gained 90% or it's moved against me by 40 or 50%, we can set that as well. Total position change. Right now, you're a small loss, Javier, of 0.3%. But if I wanted to be notified if the whole covered call, stock and put premium, the stock keeps dropping and my whole position is at a loss of 4%, and I want to be notified of that, I might set that alert. Now, when you open the position, of course, Javier, you might have been looking specifically for criteria. Hey, I want the stock to be trading above the 20-day or 50-day moving average. I want it to be above the Bollinger Band. I want to avoid stocks that have earnings between now and expiration. But remember, you've got a covered call. You do want to be assigned. I get it, Javier. That's why you sold the in-the-money covered call on this position. But, if you wanted to be notified if you're a certain number of days until earnings, 5 days until earnings, or till the ex-dividend date with an in-the-money covered call, so on, if you didn't want to be assigned, those are different alerts you can set as well. Well, let's go ahead and save those. Nothing should be triggered right now based on what I put in. But you see that we'd have some of those alerts set now for the upper and lower range. And if those alerts are triggered, that's when I'd look to do it. Right now, I think you're in a very safe zone. You had a 17.1% downside protection. Drop of 4%, we didn't want to see. Why has this drop happened? Well, there was some interesting news the other day, but there was also some strong earnings, surprise earnings that came out at the beginning of the year. Around the time you enter this, we saw those big moves, big earnings from, I forgot what it was. It wasn't Taiwan Semiconductor. But it was one of those other ones that had a big surprise earnings of the chip makers that supply the chips for NVIDIA, for AMD. And you saw MU, which was down 25, 30% last year, had a jump up of 10% 3 days ago and then 4% yesterday when the market was down. I didn't check to see if it was up again. It's something that I have had my eye on because it was so depressed last year. But MU provides the initial chip to both NVIDIA and AMD. And their other competitor in the market had a blowout earnings. It wasn't SMCI, it wasn't TWS, but SMCI and TWS moved up with it. And the rising tide lifts all boats. It wasn't AVJO, William. We'll take a look at that in a minute after we get through Javier's question, and then we'll jump into Thomas's question. Now you hear me. Let's just link to the profit and loss chart, Javier. It was SMCI. It might have been, but SMCI is going through other things. But let's take a look at the profit and loss chart, William, for Javier real quick. You've all heard me say that I'm a proponent, of course, of the radioactive trading, the married put techniques, not only because, hey, it's a product we sell, it's a product we support, I host webinars on it, I trade it with 55% of my portfolio. I converted mostly over to the married puts in about 2008, 2009, when we first partnered together with Kurt Frankenberg, the original author of the blueprint. When he sat down with me, came out to Delaware from Colorado, and he said, hey, Mike, what are you trading right now? I said, hey, I've got a couple calendar spreads going. I've got these 5, actually 7 at the time, I think it was standard collar spreads. I had moved on from covered calls to standard collars because I love the protection. I've got some credit spreads going on, and I'm following some of the iron condors that PowerOptions applied when it was available at the time was running as well. And Kurt said, well, what are your break evens on those positions? Like, well, I've got this stock here, this blah, blah, blah. And he said, no. If you can't tell me right off the top of your head what your break even is and what your goal targets are and where you are in each of those positions, then I think you're over trading. And I said, well, outside of the PowerOptions tools, I can get alerted as soon as something goes wrong. But, we talked about it, long story short, and we went through a back test that we had on PowerOptions, and I looked at what my performance on my standard collars would have been in the past 2 years versus what they would have been with married puts without the income methods. And it was a factor of 2.5 to 3 times more profit I would have made than using the standard collars. So I was sold, of course. But that's one way to protect a portfolio. The married put is the preferred way for a long-term holding. A stock that I'm bullish on, that I feel has the potential to move up 3 to 6% in the next 20 to 40 days, with the potential to move up another 5 to 8%, let's say, in the following 60 to 90 days after that. I want that upside. I have the ability to sell calls to lower that initial at risk. I have the ability to move the put. But an in-the-money covered call acts as its own protection. In my opinion, right now, Javier, why I'm saying this is you're safe. You've got a 4% decrease in the stock. I know it's a concern, but we've had some hiccups. We're waiting to see the inflation numbers next week. We know there's going to be some issues with that. In general, I talked about looking at a 7% decline in the stock in the first 20 to 40 days. It's moving against you. You might consider exiting the position. That's a William O'Neill thing from Investors Business Daily, and it's a good thing to follow with an at-the-money or out-of-the-money covered call, something that you've bought. Hey, even if I bought a long call and the stock falls 7 to 8% in the first 10 days, it's not doing what I expected. I've got to start planning ahead. But in this case, you have a 17% downside protection on this position. You're only down 4%. You're at a small loss right now, but the goal is, hey, as long as the stock stays above 120 in the next 42 days, I'll get assigned and make that max 2.2% return that I was expecting. Now, in this scenario, what am I going to look for? I mentioned it when we talked about the portfolio. Our preferred look on this kind of covered call is if the stock reaches, and the same thing I used my bull puts, by the way, out of the money bull puts, Javier, if the stock reaches within 1% of my sold put, or if it reaches within 1% of my in the money sold call strike price, that's when I'm going to look to take action. Okay. I may roll down the call, may have to roll out to March, but I may roll down to the 150. Now we're talking here, of course, that 1% is if the stock fell down about 122, 121.50. Then I'm going to start taking action. If it continues to fall and it drops down to 130, of course, if it drops down to 128 and then it drops down to 125, you might take action at that point as well. Why did I spend all this time talking about the married put versus talking about the in-the-money covered call? Because someone might say, well, why don't you just buy the put now? You advocate the married put approach. Why not do it? No. Because that's going to change Javier's whole dynamic of what he wanted. He entered this protected position with a potential 2.2% if assigned with a 17% downside protection, and the stock's only 4% down. He's seeing a loss right now, but as time goes on and the stock stays above the February 120 call, what's going to happen? The time premium is going to decay more rapidly. We're probably about here with 42 days to go. And half the time, we're going to start entering that faster slope. So even if the stock's hovering here at 130, this is going to be more affordable to buy back and to roll to a March 120 call or even a March 115. Still keep it profitable as well. So in this case, I don't think you need, I know it's not going the direction you want. I know you're a little bit hesitant, Javier. Hey, I just opened a position, a covered call 3 days ago. I've seen it drop down 4%. That's related more to the market conditions and the news that came out in the past couple of days. Your position is still looking good. I'd use the portfolio to set that alert. Maybe look for a 10 to 12% decline. Set an alert for a 10 to 12 decrease in the stock, the percentage decrease. If the position, the percent position change on the portfolio is down 5%, we might consider an adjustment at that time. Right now, you're only down about 0.3%. We're still good. If the stock reaches within 1% of your short call strike price, or around the 120, you could set the hard alert versus the upper limit or lower limit, of the stock of 122, 121.50. Then that's what I would do. But right now, I think we're in a safe place. I wouldn't recommend buying a put to convert this to a collar because that would change the dynamic and you likely wouldn't have a positive return. All right, so let's go ahead and take a look at that real quick, why I wouldn't do it. Your protection initial thought was with the in-the-money covered call. Yes, I'm going to advocate buying puts. I'm going to advocate the married put approach. You know that. I'm going to advocate standard collars, something I still do in my portfolio from time to time. But even if we looked at a 110 put for February right now, we collected 24.41 on the 120 strikes. You only had about $3 of wiggle room. But let's look at that 115 for February 21st. Now that the stock has declined, sorry for the scrolling. I didn't realize there were so many strikes still available for NVIDIA. I was down in this range. Now, it's not bad. It's at 143. So we're still going to have a positive return. But right now, remember, you're looking at a 2.2% return as long as the stock stays above 120. It still has 16 points to go to hit that price. We buy the put, cuts the profit down to 1%, and the maximum risk is only 3.3% if the stock continues to fall. Would this be a lower risk than if the stock was below 115 with your covered call position? Yes, it would, monetarily and percentage-wise, Javier. But now you've cut your potential return for 42 days by more than half. Is it worth it to do that? I think we're still in a safe spot. One last thing I have to check. This is that position. Okay, your earnings aren't coming out until 2/26. I'm sure you checked that out before, Javier, so that's perfectly fine. I wanted to make sure of that before we continue the discussion. 21st of February, 5 days before the earnings, that's not a problem. I think you're in a safe zone right now, but I think I would set those alerts, as I mentioned, in the portfolio for if the stock decreases 10, 11, or 12%. If the option, of course, starts to go in the money, but I might even go with that 1% rule that I mentioned, putting a limit, of course, if it reaches, what did I say, 121.50, for example. And that's a red warning. I know it's close to your strike price, but that's sort of the 1% rule that we follow as well. And we'll just go ahead and save those alerts also. All right. Now, again, if those do happen, if those alerts do get triggered, what are you going to do? You have your position in the portfolio. You're going to click that PPA link. You're going to scroll down here, see where you stand. Again, I'm still looking good, but here are some rollout opportunities where you could roll down the call now and receive a higher adjusted net credit, maybe increase our return a little bit going to these lower strikes. Personally, I don't think now is the time. I think that'd be over trading, Javier, and I don't think that even though the rollout opportunities appear for what you have right now, I'd wait for the alerts to be triggered before actually making a move on this position.